Hello, everyone, and welcome to today's webinar, How to Grow Your Business with Equipment Financing, brought to you by Barbara Griffith, President of SCL Equipment Finance, a division of Southern California Leasing Incorporated. Assisting Barbara is Crystal Harrison, their Business Development Manager. My name is Haley, and I'm the Member Program Specialist here at IFAI, and I will be moderating today's session. This webinar is being held to inform members the basics and benefits of equipment leasing. You will have the opportunity to submit text questions to Barbara and Crystal by typing your questions into the questions box on the bottom right of the control panel. You may send in your questions at any time during the presentation. We will collect these and address them during the Q&A session at the end of today's presentation. With this, I would now like to introduce today's speaker, Barbara Griffith.
Thank you, Haley. It's my pleasure to provide this webinar and this education so that companies can understand how to find capital. So we're just going to dive right in, tell you just briefly a little bit about SCL Equipment Finance. We are a nationwide equipment finance company. We've been established since 1992. We've become a leader in the business when it comes to financing. We provide financing in the U.S. and Canada. So that's who we are. I wanted to just share with you before I get started on what I heard on NBR last night on the news. NBR is National Business Report. It's a PBS news channel. If you've not ever watched it, it's great. I like it personally because there's no information about politics. It's all about business. And it gives you a really good insight about what's going on day to day. So NBR, look for it on your television. And they did a survey, and they said that like 48% of anyone applying for any type of a loan does not know what the lender is looking at for approval or even what the criteria is to get that loan. And they did say whether that was a mortgage or whether that was a business loan. And then they went into the street and they interviewed people, and they said, if you were going to get a business loan, what would you need? And they were like, I don't know. They did the same thing for people looking for mortgages, and those people said, I don't know. So we don't want that to our members here. We want our members that are running companies to know a little bit about financing so that you have some information because it will benefit you. So let's just go over some equipment financing facts. 81% of businesses prefer to have a payment over paying the full sales price, meaning piece of equipment's $100,000. I would prefer to pay $2,000 a month rather than bring $100,000 of capital out of my company to pay for a working piece of equipment. So survey says 81% of those businesses prefer to have a payment. 84% of the businesses are without financing when they start to search for equipment. So that's kind of interesting. So businesses know what they need. They know that they need to replace technology, but yet a lot of us don't even think about how we're going to pay for it before we even approach the dealer that we're going to buy from. So have that kind of in mind, the method of payment. It will also help you with negotiation when that vendor who sells you the equipment, that manufacturer sells you the equipment, they know how you're going to pay. Let them know your idea of how you're going to pay. 94% of businesses owners would return back to the dealer that provides the financing options. So ask your dealer, do you have a financing option? Because that's going to build a relationship with your dealer. Most dealers do have a financing referral. 73% would rather not finance equipment from their bank. A lot of dealers or companies think that they need to go to their bank to get financing, when most companies who have a very strong relationship with their bank want to keep those bank lines intact and not use an additional source of funds to buy a piece of equipment. They want to keep that credit line open. And we're going to talk a little bit more about that shortly. Okay. So, equipment markets and developments. So we didn't do, but we looked into some industry information, and more equipment companies are reshoring their operations from overseas back to the United States. So in the specialty fabric industry, we are seeing that a lot of that business that at one time went to overseas, that is coming back to the United States. And with that being said, our companies here have to gear up for that business. So that's kind of like some research that was done that says that our business is coming back to us. Customers seem to be more indecisive in making purchasing decisions for equipment. They're kind of waiting, and I think a lot of reasons why they wait is capital. Let's face it, it costs money to put new equipment inside your place of business. What do they need to buy? What do they need to buy? What is the right solution for their business? That's where research comes in. And I was speaking with Haley earlier, and IF AI and Haley directly has a really good referral source where if you're looking for a piece of equipment, you easily can call her and talk to your organization, and as a member or even not a member, she can help direct you in finding a good solution for what you might need for your application. So if you're in the marine industry and you're looking for a sewing machine, she might help you be able to find that right solution so you can go out and make that decision on what you need to buy. Why are companies replacing equipment? Well, labor cost. And I know one of the biggest problems that we have in the specialty fabric industry is labor. Gosh darn, we didn't teach that particular industry to young people growing up today, so we don't have that labor market. And then also just simply technology. I mean, if you buy a bunch of fabric and you're wasting some of that fabric because your equipment isn't really doing what it needs to do, replacing older equipment and conserving that is going to be one of the reasons why you want to consider making a decision to replace older technology. Of course, working capital can be a delay, and that's why we're having this webinar today, so that we can ease you on that, the fact that working capital is available to you and you can lean on financing to be able to move your company forward. What is capital? That seems like an easy question, doesn't it? But people really, sometimes businesses don't understand really what is capital. Well, capital is anything worth of value. So it could be cash. It could be an asset like machinery that is already paid off. Capital could be factories like purchase orders. Anything that has value to your company is really capital. More capital, more successful companies. I Googled the other day the top 10 concerns of any company. And you can do this too. You can just Google that. And number 6 came up, lack of capital. And then as you continue to read, it said that the number one reason why companies can't grow or actually go out of business is lack of capital. So we want you to understand how to use capital within your organization and how to acquire capital, because you do need capital to grow your companies. You need other people's money at a fair rate in order to grow your company. There's so many types of financing that is available, and we're going to walk through those so that you know, and you can kind of we're going to briefly go over it, but you're going to know a little bit about it, and knowing a little bit about something is good, especially in the financing industry. So debt financing, equity financing, equipment financing, and I do know that this particular webinar is more about equipment financing, so we're going to talk a little bit more about that, but I still want you to have a little bit of, let's call it ammunition, and know a little bit about all the different type of financing out there for your business. SBA loans, just to give you a little bit of information on SBA loans, my opinion is that you need to look at all types of loans before deciding on an SBA loan because of some of their rules and regulations. So talk to your banker about all of those criteria for SBA. I don't like the idea that SBA is a floating rate, and also they do capitalize on, and they own every capital equipment that you own. They own basically everything in your business when you have an SBA loan. They're great loans for real estate, sometimes working capital not so much if it's less than $500,000. And that is my opinion, but we do provide SBA. Your banks provide SBA, so just make sure you know what you're buying when you get into an SBA loan. We're also going to talk about working capital, meaning just plain simple cash inside your company, and we're going to talk about AR financing, accounts receivable. Okay? Let's start with debt financing. So debt financing is pretty simple. Company has a lot of debt. They might have 10 different loans, AR financing, equipment financing, credit card debt, all different types of debt, and every month they're just paying off a lot of debt aside from payroll and rent and mortgage and all of that. So a lot of companies want to restructure that debt. They want to restructure it so that they can get kind of one payment. So normally when debt financing is offered to a business, it could be short term, and you can repay it within 1 year. There are new programs that have come out that are up to 24 months, but they're usually limited to repaying the loan with interest. And loans are often secured by other assets of the company. So let's take, for example, you have 5 pieces of equipment, several different loans that are unsecured, and some purchase order financing that, or you owe some companies for maybe some fabric. Someone will come in and take you out of all that debt, but you might have to put up the 3 pieces of equipment in order to securitize that loan, okay? And where would be the best places for you to find that type of debt financing? Traditionally, you go to your bank. You simply go to the current bank that you're working with and ask them if you can do some debt restructuring. Savings and loans, credit unions, commercial finance companies, and SBA guaranteed. Again, we bring up the SBA because they'll do a good job with that debt financing. Accounts receivable. This is another type of way for your company to acquire capital. Again, capital is needed in a company to be able to grow, basically for an owner to be able to sleep at night. Let's face it, when lack of capital is one of the reasons why companies go out of business. They have a hard time, and you don't need to go to that area of the company. You can always depend on your assets, your capital, and a purchase order is capital. So let's just say that ABC company is giving you a purchase order for 100 units, and that 100 unit reflects $500,000. And that 100 units of product is going to be sold within the next 12 months. Now, for you to be able to provide that 100 units of material or product, you're going to have either new equipment, you're going to have staffing, you're going to have to buy the fabric. There's going to be some cost that you're going to need in order to get that done. So you could sell that purchase order to a purchase order company. So if that purchase order is worth $500,000, you can turn that into cash right away by selling that actual purchase order. So AR, people that owe you money, AR financing. Good sources for that are your banks. Talk again to your bank. There's independent AR financing companies in the industry. Be a good consumer. Ask for referrals when it comes to all of these different types of products. It's kind of a scary place to be when you're on the internet Googling AR financing. You'll probably come up with a whole bunch of stuff and you'll be extremely confused. So a good landing point is to talk with your commercial equipment finance company. They usually have good referral sources. Your bank has good referral sources. Other friends in your industry might have good referral sources. I personally like to work with referral sources versus finding a company on the internet, right? Equity financing, really simply, you own 100% of your company, you're going to grow, you're going to sell some of that equity. You might want to stay 51%, so you'll have control, and sell 49% or 10%. Who could be your investors? Your investors could be family, it could be friends, employees. If you're taking an exit out of the company, you don't see yourself working at this company that you built for the next 10 years, you might find an employee who would love to be an investor in your company. Talk to an attorney, of course, about putting an employee equity financing available. Talk to your attorney about putting an equity share to your employees. Your customers might be a good equity share member, your industry, your colleagues. So those are your investors for when you want to sell equity. Venture capitalists, very hard, kind of like the Shark Tank. That's very hard to really do, but not impossible. Why is that? Because, again, we're bringing back our specialty fabric industry back to the U.S. We're seeing more construction companies. We're seeing more marine, automotive, agricultural, fabric and fabric graphics, truck covers, awnings, recreational. All of this is coming back. So venture capitalists are kind of interested in the growth of that right now. Equipment financing, any method of extending capital to businesses for the purpose of acquiring equipment. I must say that equipment financing is going to be the easiest road to get financing because we're going to take the piece of equipment that you're buying as our collateral, unlike buying a share of your company under equity financing, unlike trying to go in and do a restructure of debt or even selling your AR. So if you have a contract, if we get right back to that contract that you received for $500,000 over the course of 1 year, and really one of the biggest problems in order to be able to service that new contract for your company or that purchase order is the fact that you just simply need new technology. You simply need to expand your operation. You need new equipment. So you wouldn't really go and use your credit line for that purchase of equipment. You wouldn't go and sell a purchase order to an AR company for that capital. You wouldn't definitely sell your company or give away shares to buy equipment. You'd use an equipment finance company in order to buy that piece of equipment because the equipment is the collateral and it's going to be the easiest road of resistance. 80% of all U.S. companies, that's whether they're the large 1% or the small independents with 1 or 2 employees. If you put all of those businesses in the U.S. Into one boat, 80% of those companies finance. So sometimes people think, well, Home Depot finances all of their forklifts, okay? Kraft Foods and any of those, they finance pretty much all of their operations. Actually, if you take a look at the 1% businesses, which is the top tier, they're financing most of everything that comes on board because they keep capital, because capital is great for them, right? Stockholders want you to have capital. So don't be afraid of acquiring funding through other methods because that is how businesses run. So 80% of all U.S. companies finance some or all of their equipment. Interesting fact, equipment financing today is a $1 trillion a year industry. 2008, I know I hate to bring it up, but if you were in business in 2008, it was tough, right? That year, the equipment finance industry funded $580 billion. Still a lot of money. But today we're at $1 trillion. What does that tell you? That tells you that we are growing as a nation, our companies are reinvesting in their companies, and that companies are purchasing equipment. We're at $1 trillion, and we will reach over $1 trillion when 2019 is over with. We're going into 2020, we will be even more than $1 trillion. A lot of tax advantages, Section 179, which we're going to talk about shortly. So our government wants our companies to invest in themselves. They want you to replace older technology with newer technology. When you are financing and leasing a piece of equipment, you are essentially renting the same way you might rent an apartment. So that is a key statement here to the easiness of getting and acquiring equipment. So I'm going to take you a little bit of history. In the early 50s, 1950s, 2 companies came out, GE Capital and Weyerhaeuser. They decided that they would go into the business marketplace and offer sort of like the rental of money and supply businesses with equipment financing. And because the rule was a rental money and not a loan, the qualifications of being able to qualify was much easier for the business. And that's what sparked the equipment finance industry. And it still runs on that. It's really, people always say, what's the rate? And the rate basically is a rate factor, and we'll also cover that later. But you're really renting the money. So whoever is providing you with the funding, whether that's your bank, your commercial equipment finance company, they're making the rules of how you can acquire that. They're not really having to go and be federally regulated because equipment financing is basically the rental of money. And because of that, the rules are much easier for businesses to acquire funding for equipment. One of the advantages to equipment financing is fixed monthly payments. Businesses do not like surprises. They like to be consistent. They want to know what their outcome is, what their yearly debt is, and they want to pay that and they want to plan for that. So when you're choosing a finance program, whether that's any type of loan, you want to try to get that to be a fixed monthly payment. All of the leases that you'll buy in equipment financing space, let's say, is a fixed monthly payment. They also cannot re-audit you, which I found that to be a great problem in 2008 to 2015, where companies were having loans with different banks using maybe credit lines, and that bank would say, I need to have a new financial statement this year to see if you could support the debt. Where, let's face it, businesses go up and down. And that's a scary thing when you have to give financial statements to your bank every year or even every quarter. One thing about equipment financing, as long as you're making those payments, we can never re-audit you. Okay? Equipment financing will improve and preserve your cash flow. So going right back to, I have this new contract, I have to buy new equipment. What am I going to do? Am I going to take a couple $100,000 or even $50,000 out of my business? And am I going to buy that piece of equipment with cash? Probably not so much, because you want to conserve that working capital. You want to conserve your cash flow. You know, there's a reason why there's a saying, cash is king. Companies that have a lot of cash, they become more valuable. Cash flow is very, very important to businesses. In today's environment, it's easy to get a loan in today's environment. But what does tomorrow look like? Do we know that if our funding arenas are going to tighten up their belts and have you hop through a lot more channels in order to get a loan? Well, we don't know that. It was very difficult to get a loan in 2010 and 2015. Kind of started opening up in 17, 18, and 19. So you have to depend on that cash flow. You have to depend on what you have in cash. In order you get a big contract, you want to make sure you have the cash flow to be able to survive. Equipment financing and purchasing equipment simply has accounting benefits. Businesses can upgrade their technology. They can replace old equipment and, again, conserve credit lines. Okay, a credit line is really with your bank. I encourage everyone to have a credit line, but they're really used to take the money out, use it for a window of a time, and then pay back that credit line and then move forward. So, for example, I'm buying some fabric at a really good price, and I have to buy it today, and I'm going to use my credit line to do that. And then once I have my product made, I'm going to pay that credit line off as soon as possible. So use your credit lines as working capital. So when I talk about the ease of getting into a piece of equipment and finding that capital so that you can purchase that equipment, it's really easy. There are programs out there with your bank, with commercial equipment finance companies. And again, I'm going to mention that, talk to the vendor that you're buying your equipment from. If they have a good commercial equipment finance company, go to your bank and see what programs they have and just, inform yourself. But I find that business clients like application-only programs where you do not need financials. And those programs in today's environment go up to $500,000. So let's just say that you are purchasing a piece of equipment for $100,000 or $250,000. You can get qualified without showing us 2 years corporate tax returns or a profit and loss. You can, in most cases, be able to qualify for that financing without a financial statement. That's what the industry in today's real time is offering, okay? The piece of equipment is the collateral, and let's face it, that piece of equipment that you're going to purchase, that you're going to bring into your operation, is going to save you money. And today, your balance sheet and your profit and loss statement may not show or reflect that cost saving of that piece of equipment until a year from now. So it's kind of unrealistic sometimes when financials are asked of a company when they're trying to acquire a new assembly line, because that assembly line hasn't proven its worth until it's operational and performing. So look for the application-only programs. They compete just as well as any bank loan, any SBA loan, and we certainly wouldn't want you to sell some of your company to buy a piece of equipment, right? 100% financing. So it will include everything: installation, tax, shipping. So 100% financing. Fixed payments. Again, all equipment financing programs are fixed payments. Here is an area that you should know about. And if you take a few things away from today's webinar, know about the end of lease options. There's two different types of buyouts. There's a dollar buyout, which is more like an equipment finance program, right? You make your payments, and at the end, you own the equipment, right? That's actually called a capital lease. And then there's the other type of option, which is fair market value. A fair market value is called an operational lease. Those are two good words to know when looking for financing. Fair market value has a balloon payment at the end. You have the option to return that equipment and not own that equipment. Both of these types of end of lease options have different consequences for tax benefits. So for example, on the dollar buyout, you would depreciate that equipment. And on a fair market value, you would expense the payment. But you want to make sure that you know at the end of the lease term how am I going to take possession and own this equipment. So talk to your equipment finance company about the two different buyouts, and talk to your CPA about what buyout works best for your financial statement. Working capital. You can obtain working capital up to $500,000. Working capital is just that. Working capital is a cash loan to be used towards everyday operations of the business. Typically, they fund between $5,000 to $500,000, and they're called microloans. And you can use that type of working capital for payroll, for just everyday business costs. Credit cards are actually considered working capital. So if you have a good credit card that you use and put that particular debt on credit card, maybe your fabric or whatever I kind of like credit card because it kind of has that net 30. I know that our company uses American Express. We have a good relationship with them. So look for those good credit cards out there. Accounts receivable, which we just talked about. That's one way of bringing in working capital. So look for the different types of working capital and understand where you need to add that working capital, whether that's a piece of equipment, whether you're going to sell a purchase order, whether you're going to put it on a credit card. We're going to talk a little bit about good credit versus bad credit. When I said earlier today that on the news, NBR said that the average American doesn't know what it takes to actually get a loan, whether that's a mortgage or whether that's a business loan. Well, I'm here to share with you where to start. Personal credit. Start with your personal credit. There is a website called annualcreditreport.com. That is a service provided by Experian, TransUnion, Equifax. It is supported by those three companies. You get a free credit report once a year. If you go on to any type of credit report agency and they ask you for money, you're on the wrong site, okay? Annualcreditreport.com. You can look at your personal credit if you see anything derogatory, you can dispute it right from that website. But once a year, you should look at your personal credit. Whether you're a business or whether you are a consumer, have your family members look at their personal credit. It's just a good thing to do. You know, stuff happens, right? And things get put onto your personal credit that you have no idea. And you need to, take care of that. And we, consumers, don't forget, there's a lot of consumer laws. We fight every single day to bring consumer laws to us. And we have them. And it is basically can be disputed, and the credit reporting agencies, in a dispute, if it is truly the wrong information being reported, then they have 30 days to remove that, because our consumer rights requires them to remove negative information within 30 days if it's derogatory information and not correct. Okay? Personally, what I like to do, if I find something on my credit report that is not correct, I will just add in where it says to dispute. I just write simply, this is, not correct information, please delete. I think some people take it a little bit too far and say, I never did business with ABC, and ABC, I just talked to them one time. It's like nobody cares about that. So when you are disputing negative information on your credit report, keep it very simple by just telling whoever is looking at that credit report, not correct information, please delete. That's really important that you use those words so you can direct the credit bureaus to know what to do with that derogatory information if you dispute that, right? Okay, moving right along. Business credit, really important that you develop business credit. Think of yourself as the owner of the company and the business. Whether you're a proprietorship, corporation, LLC, partnership, you still are separated from your business. Your personal credit buys you your home that you live in, sends your kids to school, buys the cars that you drive back and forth to work. But your business has its own credit, and it needs to be separated. As simple as that. There are business credit reporting agencies like Dun & Bradstreet, PayNet, Experian Credit. Look at your Dun & Bradstreet report and see what creditors are saying about you. If you go out to look for a line of credit with your bank, you go out to look for an equipment loan, everyone is going to pull a D&B. You may or may not have one. If you don't have one, it's okay. If you do have one and your credit score is low, that's a problem. So again, you can correct all of those things by just being informed. Now, we are a member of AFAI, and because we will give your company a free copy of your credit report. They're about $300 if you were to Google Dun & Bradstreet, I want a copy of my credit report. They're going to range anywhere from $99 to about $300, so you don't need to do that. You can simply just get a hold of Crystal. She'll be happy to pull a report. Listen, we pay our $10,000 a year to have a membership with Dun & Bradstreet. We're able to inform our clients about their credit report, their business credit report. So just simply ask Crystal for a copy. She can also walk you through it so that you can understand how to read it. And if it does have some information on it that's not correct, we want to correct it. If you don't have a D&B, we want to get you one. So just lean on Crystal for that free copy of the D&B report, okay? So again, one of the first things that lenders will look at when considering funding for the customer is personal and business credit history. So how do you establish good business credit? Well, You open up a business bank account and you begin using it regularly. One of the things that I believe that you should do is that you should start considering other banking relationships. If you're working with, one bank now, maybe try a credit union. Maybe a credit union within 5 to 10 miles away from your office, and open up an account with them and go in there and talk to a loan officer and just tell them about your business and your goals and see if they can be a good partner for you. One of the most valuable assets that you'll ever have in your company is your financial partner. So you need to establish good working relationships with your financial partner, and finding the right source is really important. Apply for business credit cards and trade lines, because with that, you're going to build that Dun & Bradstreet report. And of course, we just talked about it, but check your business report regularly. Once a year, that is my suggestion, once a year. So we want you to know lenders' consideration in loan applications. Okay, so again, if a lot of us don't know really what our lenders are requiring, then how are we going to properly fill out the application and get the approval? And even if you are going to open up a bank account with a new bank, a new savings and loan, or a new credit union, or just simply a new bank, you're going to want to go in there and you're going to want to represent yourself. So here are some of the things that they're going to consider. Can the business repay the loan? Okay, I'm looking for a $100,000 piece of equipment. This piece of equipment is going to make me $7,000 a month. My payment is $2,000 a month for my loan. So I have a cash flow of $5,000. So that's the ability to pay back. That's really explainable. If you look for a line of credit, you tell the bank, well, I need a line of credit because I buy fabric and I need to buy it at a discount. Currently, I'm paying, I need to be able to exercise funding as good deals come in. And this is how I'm going to repay that loan. So they want to hear not so much that your financials show that you can repay it, but the reason why you want the loan and how that loan is going to help your company. All right? Can individuals repay the loan if the business fails? Very interesting. So they want to kind of look at that. It happens. So an equipment finance, one of the reasons why it's so easy to get into a piece of equipment is because the equipment is our collateral and we will pick up the equipment. Does the business consistently pay its bills on time? That's a very good one, okay? Credit. When we pull personal credit, if we need it, or we pull business credit, and if either one of those show that entity is not paying their bills on time, the odds are whoever's funding you will not get their payments on time. So your rate and whatever your cost of funds are for whatever you're going to be purchasing in a loan is going to go up because of the risk versus the credit. The credit tells us, we're going to probably get a lot of late fees from this customer. So we're going to charge them even more interest. Versus a company that pays their bills on time. The odds are we're going to get our money on time, so our rate is going to go down because we don't have to service this account. So the risk is less. Can we tell that? How can we tell if a business can actually or do pay their bills on time? One of the ways is bank statements. Sometimes your loan officer or an equipment finance company may ask for bank statements. Bank statements tell us a lot about how the company pays their bills. Another area, if you're going in to buy to apply for a new loan, is are the officers committed to the business? We want to hear that underwriters want to hear that the owners of companies are committed to the business. That if your business is located in Texas, you don't live in New York. That you are there day to day. Okay? So when you're looking to get a loan, they want to hear that you're committed to the business. Does the business have a profitable operating history? They might look at your profit and loss statement. They want to hear that. Some good areas in which to explain if in fact you don't have a profitable operating history is the fact that if I get this new piece of equipment, or if I get this credit line, or if I bring capital into my company, I can change my balance sheet. I can change my profit and loss. And you're going to go through why, right? So if we know that business is coming back to the U.S., we're speculating that if we improve our companies, we're going to get some of that business. So that's a very good answer to anyone asking you why your profit and loss statement may not show profitability, okay? So don't let that one hinder you. We just need to be able to understand how to present, right? All profits increasing as a percentage of sales. Okay, everything has gone up, right? Everything. So what you charge for your services most likely has gone up. And then yet we still have to be competitive, right? So again, speaking about a new piece of equipment, speaking about a new piece of technology, we're hoping that when you bring in this new piece of equipment, it's going to help you conserve money, maybe by not having to hire so many employees, and maybe the cost of your product can stay competitive, right? Those are things to consider when looking for a piece of equipment. All right, because it really is about what, we all say, well, why are we buying so much from China and from other parts of the country? It's because Americans like to buy cheap products. But Americans really don't like to buy cheap products. They want to buy good quality products, and American-made companies, things that are made here in America are good quality products. I know, for example, when you buy a piece of equipment from China, it doesn't last as long as a piece of equipment that is made here in the U.S. And I can assure any client that if they buy outside of the U.S., that if they bought, let's say, an awning, contract here, and they had an awning company make their awnings, it's going to be a much better quality than overseas. So we want to keep our standards up, but we want to keep our, be very competitive. Sorry, went off on that a little bit, but is there any problems with cash flow? So they want to understand that. Yeah, problems with cash flow. Here's a good example. I have 28 employees. When I buy this new piece of equipment, I'm going to have 20 employees. And I'm going to bring on a larger contract, and I'm not going to have to hire any more employees. So you can explain that, right? And what is the future of the industry? Well, it's good. The future of the industry is good, and you can do some research and show the bank, because listen, bankers are bankers. They don't know everything. They don't understand most industries at all. They understand one thing: what are the cost of funds? So you're going to have to educate whoever you're working with about your industry. And you should be very excited about your industry because it's a growing industry. All right, real quick, Section 179. So these are some tax benefits that you can take. The government allows you to expense up to $1 million in equipment financing. Okay, I'm sorry, let me take that back. $1 million in new equipment. Whether you finance that equipment or pay cash for it, you can still expense it. Okay, up to $1 million. So real simply, I'll just put it real simply. Your company makes $2 million. At the end of the year, you have a $250,000 profit after you've taken all your expenses. You're going to pay taxes on that $250,000. You bought a piece of equipment this year. That piece of equipment was $250,000. you could expense that $250,000, and now your tax liability for that year would be zero because you took that 100% write-off under Section 179. And that write-off in 2008 was $25,000. And I think about 4 or 5 years ago, it went up to $1 million. So what is the government telling businesses today? Buy equipment and expense it out. All right? Here's how it might look. If you bought a piece of equipment for $1,150,000, you have $1 million write-off. You have a first-year depreciation of $150,000. Your first-year deduction was $1,150,000. You actually saved $402,000 this year. Okay, so that just kind of bullet points that. All right, so this is the time where we're going to take some questions, and I'm going to hand it right back to Haley.
Thank you, Barbara. So we have one question that's come in so far. Do buildings qualify as equipment?
No. Buildings are an asset under real estate, so that would not be an equipment type of loan. That would need a real estate loan if you were trying to get a loan on it, but a building itself is not equipment.
Okay. Just wait a sec. Do finance companies or banks charge any upfront fees? For example, deposits, origination fees, etc.?
Hi, everyone. This is Crystal. Just wanted to answer some of these questions for you guys. I'll go ahead and take this one. In most cases, there's no origination fee or deposits for equipment financing. The most you should have one payment in advance that would be applied to your financing, and perhaps and or a small documentation fee. But rule of thumb is to always ask the lender or ask who you're working with if there are additional fees. Always communicate, ask up front.
Thank you. Another question is, how long will it take to get approved?
Sure. So generally, an approval should take about 24 hours to 72 hours at the very, very most for equipment financing, anything up to $500K. And that is under the application-only program that Barbara was referring to, that we highly recommend without financials. It depends, how well the application's completed. If you've provided everything that's been asked for to the lender, if the amount is higher, over $500K, and there's financials involved, the process can possibly take a little longer, 3 days to 3 weeks perhaps. But, really, if you're going up to $500K, the application only, you should be within that 24-hour to 72-hour time.
Right. And Crystal, let me just chime in on that too. When you're working with someone in your banker, a commercial equipment fund, whoever that loan officer is, those are very key questions, and Crystal's absolutely right. Ask, what are your origination fees? What other fees do you have that is associated with this loan? Also, ask them, how long will it take? And so if you put that on the table in the beginning of applying, I think you'll find that they'll live up to those comments that they make back to you. Okay?
Okay. And then another question is, can I finance used equipment?
Absolutely. Banks actually, they like used equipment. It's it's a great asset. If it works and performs for a business and makes the business stronger, it provides value. It doesn't matter if the equipment is used. It's a great asset, and so absolutely, used equipment is great to finance.
All right. Another question is, will the equipment financers consider movable hire equipment such as tents, horse stalls, etc.?
Oh, that's a good question. The answer to that is yes. Horse stalls, if they're mobile, if they're affixed to the property, not so much. That becomes real estate. If it's a tent that, like, for example, if you're a catering company and you're buying awnings for travel with you here and there that you're going to put up, yes, financeable. So if we can pick it up and move it, it's probably financeable under a traditional equipment finance company. If it's like, for example, a mobile storage unit would be financeable, but a storage unit built into a piece of property is not financeable under an equipment finance program. Those pods that you see that people put their storage in, those are financeable under an equipment finance program. But the storage unit that you go to and drive to and put your stuff in, not financeable. So I hope that clears that. Good question. Very good question.
Thank you. Another question came in. What traceability will they require for movable equipment?
Well, that's a really good question. If you have a rental company, we understand that in most cases, your lender will add an addendum to the financing agreement, which is a rental agreement, letting us know that, or letting them know that your equipment is going to be moving around. And then, of course, you are insured. So if for some reason it gets lost during its time or damaged, your insurance company will step in to replace that piece of equipment. So you just let the lender know that this piece of equipment is going to be movable.
Okay.
A lot of equipment is movable. I mean, look at the pods that I just mentioned earlier, and a lot of camera equipment is movable. So a lot of equipment is movable.
All right. I think that's all we have for questions. Thank you so much, Barbara and Crystal, for the presentation today. I hope you guys all have a good rest of your day.
Well, thank you for allowing us to provide this information, Haley. We'll talk with you soon.
Thank you.
Bye-bye.
Bye.